Here at Citizen Television, on to business news. And the Kenyan government is back to the multinational capital markets, seeking a $1.5 billion bond, an equivalent of 235.5 billion shillings, going by today's rate. Now, according to experts, the funds will be used to repay the inaugural $2 billion bond that the National Treasury has invited a buyback order that was set to close today. But as Jimmy Mbogo now reports, it is in the interest of the $1.5 billion bond that could prove to be a fresh pain point for the National Treasury and the Kenyan economy.
The National Treasury's move to re-enter the international capital market for a 6-year bond could put further strains on the Kenyan economy. The bond, which was discounted by the National Treasury, will see Kenya receive $1.459 billion, an equivalent of 229,070,850,000 shillings out of the intended $1.5 billion or 235.5 billion shillings that will be repaid, representing more than 6 billion shillings worth of profit for the investors. Kenya's woes, however, do not end there. The country is expected to pay a 9.75% interest on the loan, which amounts to 23.5 billion shillings annually. With experts worrying that pressure will come from the 6-month requirement, where coupons on senior unsecured bonds are repaid semi-annually, meaning that Kenya will be required to offset $73,125,000, an equivalent of 11.48 billion shillings every 6 months.
The interest rate is really high. It's much higher than what we had the comparative rates for Benin and Ivory Coast.
We're moving from 6,875 to 9,750 for every 100,000 investment.
You are saying that we have been paying 21 billion and now we are going to pay 22. So it's just about $1 billion difference that we are going to be paying. It's not a lot, and it is a price to pay for, given the situation that we are in, where liquidity is tight.
The loans, which have been staggered in 3 maturities of $500 million, are set to mature beginning 2029, with repayments set to go into 2031. The National Treasury indicated that it had received a strong demand, with high-quality order book exceeding $6 billion, allowing for tighter pricing. But just what could have inspired the shift in demand? According to experts, the answers are in the interest rate, contrary to the National Treasury's assertion that it is as a result of investor confidence in the country.
The high subscription of the Kenyan bond, the Euro bond, is an indication of the investor confidence on the Kenyan economic management and our debt management strategy. It means investors, because we did a roadshow, we explained to investors our economic situation, our economic plan, and all the information they needed, and they believed in our story.
The U.S. government, which is the world's best borrower, is lending at about 6% or thereabouts. The government of Kenya is issuing a bond in dollars and giving more than 10%. People will buy.
That is how the market works. So I may not even read into this whole outsized demand as a show of confidence or things like that, but just basically from an investor's perspective and how the market really works. Yeah.
Although the cabinet has welcomed the successful placement of the $1.5 billion Eurobond, insisting that investors retain a high degree of confidence in the administration's economic turnaround strategy, experts are wary on whether the government has solved the debt issue or whether the government has kicked the debt can further down. Jimmy Mbogo, Citizen TV, Nairobi.